Welcome back to the Tesla Daily News Podcast. It's January 29th, 2026. Today, we're tracking the big catalysts ahead of Tesla's earnings, fresh data out of Europe that shows Tesla losing momentum, and new signals on autonomy, AI chips, and charging infrastructure that could move the stock. First up, Tesla earnings are the headline risk, and the market is clearly positioned for a narrative battle. The hook here is simple. Investors aren't just buying Tesla as a car company anymore, but the car numbers still set the tone for margins and cash flow. Context: Tesla reports fourth quarter results after the bell, with the Fed also in focus this week, which can amplify volatility in high multiple names. Details: multiple previews in the financial press highlight that key questions are shifting toward robotaxis, full self-driving progress, and the Optimus robot program, while analysts also flag softer deliveries as the near-term pressure point. Impact: if Tesla guides to slower unit growth or signals additional pricing pressure, the stock can react quickly because auto gross margin still anchors the valuation in the near term. On the flip side, any credible timeline clarity on FSD monetization, robotaxi rollout, or meaningful cost downs can re-rate sentiment even if near-term vehicle growth is muted. Takeaway: going into earnings, watch three things: automotive gross margin ex credits, any update on full self-driving take rate and pricing, and management commentary on 2026 volume and capex. Second, Europe's demand picture is flashing a warning, even as the EV market grows. Hook: the European market grew, EVs grew, and yet Tesla's sales fell sharply. Context: Europe is one of Tesla's most visible competitive arenas, with aggressive offerings from Volkswagen Group and rising pressure from Chinese brands. Details: ACA data cited by multiple outlets shows battery electric registrations in the EU up almost 30% in 2025 to roughly 1.88 million units. At the same time, reporting notes Tesla's sales in Europe down close to 30% in 2025, while BYD's volumes surged. Impact: that combination matters for investors because it suggests Tesla is not simply riding category growth in Europe right now. If Tesla is losing share, the company may need either product refresh momentum, better financing incentives, or further price action, and all three paths have margin implications. Takeaway: if you're modeling 2026, Europe is a key region to watch for share stabilization. A growing EV pie doesn't help Tesla stock if Tesla's slice shrinks. Third, Germany's corporate fleet market is tightening its belt, and Tesla appears to be on the wrong side of the trade down. Hook: German companies are reportedly shifting purchases toward cheaper models, and Tesla is losing ground in fleets. Context: fleet demand can be a stabilizer for automakers because it's repeatable and often tied to multi-year replacement cycles. When fleets trade down, premium brands feel it first. Details: a German business report notes that firms are buying more Skodas and Dacias instead of Mercedes and Teslas, with Tesla among the brands seeing declines by tens of percent in fleet channels. Impact: weaker fleet penetration can pressure delivery volumes and increase the need to stimulate retail demand, typically via pricing or incentives. It also changes mix, which can hurt margins even if total unit sales hold up. Takeaway: watch whether Tesla can regain corporate buyers with refreshed Model 3 and Model Y offerings, improved total cost of ownership messaging, and better leasing terms. Fourth, Tesla's brand value slide is becoming a measurable metric investors can't ignore. Hook: one of the world's most powerful consumer tech brands is being marked down fast. Context: brand strength matters to Tesla because it supports pricing power, lowers customer acquisition cost, and improves resilience during downturns. Details: brand finance reporting picked up in European media suggests Tesla's brand value fell about 36% year-over-year, cited around $27 to $28 billion, down from roughly $43 billion a year earlier. Impact: brand value is not a line item on the income statement, but it often leads the fundamentals. If brand perception weakens, Tesla's ability to maintain premium pricing and high take rates on software options like full self-driving becomes harder, which affects margin and long-term valuation. Takeaway: investors should treat brand metrics as an early indicator. If Tesla's brand stabilizes, that can support pricing and reduce the need for demand levers. Fifth, new reliability and inspection data in Norway is a potential sentiment overhang, even if it's region-specific. Hook: Tesla reportedly had the highest failure rate in EU-style inspections for certain model years in Norway. Context: quality and service experience directly influence repeat purchases and resale values, which feed back into leasing costs and consumer demand. Details: Norwegian reporting sites wrote authority figures showing that for Tesla vehicles first registered in 2021 and undergoing their first inspection last year, 8,603 out of 19,476 failed, which is about 44%. Impact. Headlines like this can weigh on sentiment and reinforce a bear narrative about build quality and long-term ownership costs. If it spreads across markets, it can raise warranty and service costs and pressure residual values. Takeaway. Watch how Tesla responds operationally, service capacity, parts availability, and any engineering fixes. Quality improvements are an underrated margin lever over time. Sixth, Tesla's AI roadmap is back in the spotlight, with Dojo and faster chip cycles in the mix. Hook. Elon Musk is signaling renewed momentum on in-house AI hardware and a push to compress chip design timelines. Context. Tesla's autonomy strategy depends on compute. If Tesla can lower compute cost per unit of training and inference, it can accelerate full self-driving iteration and improve gross margin on software. Details. Digitimes reports Musk saying the AI5 chip is progressing, Dojo 3 work would resume, and future chip generations are targeting an aggressive 9-month design cycle. Another Digitimes analysis discusses why Tesla may be splitting AI5 production between TSMC and Samsung, highlighting supply and capacity strategy. Impact. Investors tend to reward credible autonomy progress, but they also discount vague promises. If Tesla can demonstrate that faster chip cycles translate into better real-world FSD performance, lower cost, or new monetization, that's a valuation positive. If it looks like expensive parallel projects without clear ROI, it becomes a margin and capex concern. Takeaway. Listen on the earnings call for specificity, timelines, cost targets, and how compute translates into FSD capability and product revenue. Seventh, the charging ecosystem continues to tilt toward Tesla's standard, which strengthens Tesla's platform advantage. Hook. EVgo is scaling Tesla's NCS connector rollout, accelerating the standardization wave. Context. Even when charging networks aren't owned by Tesla, the NCS standard can entrench Tesla's connector as the default in North America, improving user experience and reinforcing Tesla's ecosystem leadership. Details. Electrek reports that after a 2025 pilot that put nearly 100 NCS connectors online across 22 major metro areas, EVgo expects more than 500 NCS connectors in its network. Impact. Broader NCS adoption can support Tesla's charging revenue, increase the perceived moat around Tesla's infrastructure, and reduce friction for non-Tesla EV adoption, which can expand the total market Tesla competes in. The key investor question is monetization, charging revenue growth versus capex and operating cost. Takeaway. For Tesla shareholders, this is a strategic win. The market is adopting Tesla's standard. The next question is how much high-margin recurring revenue Tesla can capture from it. Before we wrap, a quick market note. Broader equities have been pushing record highs, the dollar has been volatile, and everyone is waiting on the Fed's rate decision. That macro backdrop can exaggerate Tesla's post-earnings move, especially with options positioning around the print. Let's close with the themes. Earnings is the near-term catalyst, with margins and guidance as the core. Europe is growing, but Tesla's share appears under pressure. Brand and quality headlines are creating narrative risk. And on the upside, AI chips, Dojo, and NCS standardization keep the long-term platform story alive. For tomorrow, watch Tesla's earnings numbers, the conference call tone around full self-driving and robotics, and any guidance on 2026 deliveries and capex. If you found this helpful, subscribe to the Tesla Daily News podcast and follow for the next update.